Good evening. You're watching The Digital Age, and I'm James Goodale. The stock market is going to hell. What are we going to do about it? It's not an easy question to answer. The market is all digitally connected these days. If you have a computer in Greece or you have a computer in Russia, you can trade just as easily as if you have a stock on the New York Stock Exchange. Do we need an international agreement, something like Bretton Woods, to tie all the parts of the world together to regulate securities? Do we need another Bretton Woods? Here to discuss that question with us tonight is Bill Donaldson.
Right.
Thank you very much for coming by, Bill.
Nice to be here, Jim.
You are the former chairman of the SEC. You're well positioned to discuss this issue tonight, but you also were the founding president, so to speak, of the Yale School of Management, a former president of Aetna, and that's just a little bit of your biography. Let's start at the beginning. In other words, the beginning of your career, because you've been around. Well, I hate to say it's been half a century since you started the firm that had your name in it, and I should have mentioned that too, Donaldson, Lufkin, and Jennerette. Let's take a random walk, so to speak, down the street. Could you ever imagine, when you started out in 1959, you started as a research house, you became an investment bank. Investment banks were separated for banks where you had your deposits, that the investment banks would all be rushing into the arms of the commercial banks so that the commercial banks could save them and everyone say, that's a good idea, when the old idea was that it wasn't such a good idea? Could you imagine that?
Couldn't imagine it. Actually, if you go back to 1929 and the crash, there was, in addition to the securities laws and the formation of the SEC, there was a law passed, Glass-Steagall, which ordered the separation of investment banking from commercial banking, and that was what had gotten Wall Street in trouble in the 20s, was the mixture of underwriting and commercial banking. So the law, and that all changed in 1999 with the passage of Glass-Steagall.
No,
excuse me, with the passage of Graham-Leach-Bliley, which in effect let everybody put it all back together again.
So the street, well, the street's not there anymore. That's the other thing. Because Wall Street used to be geographically the Wall Street, but now it's sort of, appropriately for this program, a virtual street, because it's spread all over Manhattan. What caused a major change in investment banks, putting aside the fact that they've run into the arms of the commercial banks? Because when you started out, I don't imagine you had 30 times leverage on your modest equity savings, which is to say you put in, I don't know, let's say you put in $300,000. You didn't have $3 million debt at the same time, or $9 million debt, I guess, actually. How did that all come to pass?
Well, what really happened was the Wall Street that we started in, Donaldson, Lufkin, and Jennerette, was basically an agency business where in our case, we produced research. We like to think of it as being better research than we produced before, but we produced research and we did transactions and we made commissions for doing that. We changed that random commission thing to fees to us. If you fast forward through the history of Wall Street, eventually the investment banks became principals. Instead of, as commissions were deregulated and were no longer fixed, the profitability of the agency business wasn't there anymore. Wall Street investment banking firms started to invest their own capital. And there are those who say that some of the big investment banks are no different really than a hedge fund, in which they were investing their own capital, and the next step in that was leveraging that capital. So you had these huge firms who were dealing with the public, but over here they were making their profits from investing, from trading, and that became a bigger and bigger business.
The traders, I don't want to say I was around Wall Street when you started, because I came, 2 or 3 decades later. But I'm told that when you talked about trading when you started, you were talking about the traders in the back room. They were not part of the main fix, and they may have even had a green eye shade on. But that has all changed. How did that happen?
Well, again, the evolution of that was the trading in the old days was buying and selling stocks in a very simple way, either on the New York Stock Exchange or in the over-the-counter market, the NASDAQ market. And the traders were the executors of that. They dealt with floor brokers on the New York Stock Exchange. But with the advent of computers and with the advent of PhD-type financial experts, trading became a computerized process whereby you could capture small differences in stocks by the use of executing on a computer, program trading, and so we went from normal traders, as you say, on the trading desk. We went to PhDs with highly sophisticated programs, picking off, as they say, slight differences between stocks and arbitrage and so forth, but basically doing it with programs. So today, you have on the floor of the stock exchange, you have these programs coming in. The stocks are trading, and then all of a sudden, a huge program takes place of millions of shares, and those millions of shares are...
I mean, they'd be sold because the computer tells you to sell.
Because it would be according to a program devised by sophisticated, and that they would execute in volume, and that changed the whole business.
The digital age came upon us. I want to talk about some of those computer programs in just a second, but I want to ask you a question that I don't get an easy answer to. You've explained how this became a business where you had your own money at stake and you had to borrow. And all of us in America borrow. We borrow on our houses, we borrow on our credit cards, but none of us normal Americans who has a house worth $1 will go borrow $30 from the bank to pay off the mortgage on $1 to make a silly. So I can't get clear in my head how the borrowing ratio, which is called leverage, got so high. I mean, I don't have any experience in any other business where people borrow at these huge 30, 20 times their value of their house, to make the example. I don't understand that. How did that happen?
Well, there are a number of reasons. To begin with, we have a zero savings rate in this country. Okay, so people are spending everything they earn. In the late 90s, we had several hiccups in the marketplace, dot-com boom in Boston and so forth, and then the scandals, the Enron and WorldCom scandals, and not to mention 9/11, and the market was going down rapidly, and the Federal Reserve was attempting to keep up with that market decline by lowering interest rates. So all of a sudden, you know, over a long period of time, interest rates went down. So
it's too easy to borrow.
And all of a sudden, money was available. Floods of money were available at practically no interest cost.
Well, greed gets us into trouble a lot, but the computer also has gotten us into some trouble, as well, maybe we can conclude from what you said, at least to change Wall Street. I've got some theories with respect to how the computer actually contributed to the present trouble. And I want to put up on the screen a couple of quotes from the New York Times and the Wall Street Journal, which shows how the computer has been driving Wall Street, not only the way you've talked about it, but in other ways too. Okay, so here's what the New York Times said. When Graham Leach, to which we've just referred, came through and said, we're not going to regulate some of these computer products like the credit default swaps. Here's what the Times said about that historically. Effectively, what the government did was it decided to rely on the investment firm's own computer models for determining the riskiness of investments essentially outsourcing the job of monitoring risk to the banks themselves, because the government didn't want to do it. Then the Wall Street Journal asked, well, did firms put too much faith in computer models to assess danger once these computer models were in the hands of the investment banks? Warren Buffett says, wise old Warren, all I can say is beware of geeks bearing formulas. And lo and behold, there is a geek in this picture. According to the Wall Street Journal, the geek's name is Gary Gorton, a 57-year-old finance professor and jazz buff. He is emerging as an unlikely central figure in the near collapse of AIG. Mr. Gorton, who teaches at Yale School of Management, also has a lucrative part-time gig, devising computer models used by the giant insurer to gauge risk in more than 400 billion of devilishly complicated deals called credit default swaps. So I'd like to suggest, for whatever reason, Graham Leach or free market economics, we have a new computer-connected product. The government says, I don't want it, you take it. The investment banks say, I got it, but for whatever reason, I'd like to suggest maybe they didn't understand it. We're going to give it over to a geek. So the geek goes to work, he creates this product, and all of a sudden, the world explodes to the extent that credit default swaps are responsible for some of the explosion. So it seems to me what happened is we took our whole, this is an overstatement, but we took some part of our financial establishment, we put it on a geek's back, he figures it out on the computer, and everyone goes away. Now, tell me how much of an overstatement that is.
Well, I think it begins with the Graham Leach-Miley law, which did two things. It basically allowed everybody to get into everybody else's business. The banks to get into everything from insurance to brokerage and so forth and so on. Then and in the passage of that law, it was the derivatives, the credit swap is a derivative.
Right.
And that's an instrument that gets its value from another financial instrument. So the regulation of derivatives was taken away from the normal regulatory agencies.
Which could have been you, actually.
Taken away from the SEC, taken away from the CFTC, taken away from the Federal Reserve. So you had this whole area of derivatives, and in comes this new idea, which is a credit swap. And what that is an insurance policy.
Right. I lend you $1 million, but all of a sudden say Donaldson. No, he's a poor risk, so somebody's got to buy insurance on your risk.
I buy a security, and maybe it's a mortgage, pile of mortgages. So I buy that, and after I buy it, I'm worried about the risk. So you sell me insurance, and then 10 minutes later or 10 days later, you say, gee, I maybe have taken on too much risk. I'm going to sell this risk to somebody else. And so it just pyramids.
And the computer guy sort of designed the risk parameters of what we're talking about.
Well, yeah, and it gets, not to get too much into detail, but he and others helped you price that insurance policy. They helped you understand what you should charge to sell that. Right. And we did that by complicated calculations that said how remote it was that you were going to have to pay up on that insurance. Right. But what they forgot to do was the instrument didn't have to default. It simply had to go down in price. If it went down in price, then the person who bought that insurance wants more collateral. So what we've been going through is, although there haven't been that many defaults, there's been huge calls for collateral. And that's what you're seeing at a place like AIG, which wrote the largest writer of credit default swaps. And all of a sudden, everybody's demanding more collateral. AIG, at latest count, has 150 million
Million, or billion, or trillion?
Yeah.
The numbers are like 150 billion of these.
Well, no, and I was going to say the Fed has put into AIG money to be able to pay this off.
So basically, the computer guy could tell me how to price this deal we're making and make other...
How to charge for it.
How to charge for it. But then something fell between the chairs because either management relied too much on the computer, or they didn't think about the fact that maybe someday they would have to come up with extra money, the collateral you're talking about. So what's the reason? I'd like to suggest, being of the age that I have trouble, even though this is a digital age, understanding all the ins and outs of computers, that maybe there was someone more or less my generation at the top of one of these companies who didn't know what the hell the computer geek was doing. And so as long as the money came in, he wasn't going to take the time to find out. Is that possible?
It's entirely possible. And there's another phenomenon, Jim, which is that if you look at the history of the major investment banking firms, they're agglomerations. I mean, they're, year after year, they acquired more and more firms. So the major investment banking firms are a combination of many, many firms, and they've gotten bigger and bigger and bigger. And as a result, the kind of the risk they take, the size, it has to get bigger and bigger. You have to buy bigger and bigger, whatever it is, in order to have an impact on a giant company. So you go out and you borrow the cheap money, and you use that and use more and more of that, buying bigger and bigger deals, and that's basically what's happened.
Well, now you're a regulator.
I was.
You were a regulator. I want to talk about hedge funds in a minute, but as long as we're on this subject, I want to ask the same thing to you that I want to ask about hedge funds, where you have an incredible record, which we'll come to, as I say, in a minute. Should we regulate credit default swaps?
Absolutely. I mean, the first step is that we must have some sort of a central clearinghouse, so we know how many credit default swaps are out there. We have no idea. I mean, there are all sorts of estimates, 57 trillion, or et cetera, et cetera, et cetera.
The whole thing gets, when you think about it, it makes you sort of angry, doesn't it?
But basically, even as we do in other securities, there needs to be a record. We do a transaction, it needs to be done through a clearinghouse. All the members of the clearinghouse are responsible for the transactions to be good, money good, as they say. And we need to corral all of this and run it through a system where there's a record and where there's group responsibility for making good on the instrument. That's number one.
Number one. Well, number two, or is that enough?
Well, and then I think eventually we're going to have to, as we go through a resetting of the regulatory mechanisms in this country, I think we're going to have some examination of the viability of some of these newer and fancier instruments. I mean, we have a Food and Drug Administration that doesn't allow dangerous drugs in the marketplace, and maybe there's some securities that just shouldn't be allowed to be traded. I'm not saying that. I mean, I think that's an area of examination that needs to be made, and that's a controversial statement. I mean, the free market people will say,
I was going to say,
any instrument is fine, and so forth and so on. People can take risks, but again, we've seen the danger here. So the second step is not just to have trading where there's records and clearinghouse and so forth, but to have regulation of that trading, as we have regulation of trading in all other instruments. These derivatives and these credit swaps are unregulated now. There's nobody sitting there on top of this, that we can do overnight. We should do.
Well, that really is a radical statement, the first part of that statement, which would say that there'd be some body. I guess we don't know what body's going to emerge from this as the governing body is making difference for purposes of this discussion, that there would be some governmental body that would look at this. And let's say they might get if they'd been in place 10 years ago, they might have gotten a credit default swap and said, if they took the time to go through all the computer stuff, you know, this is too dangerous. But the way we've always dealt with this as a country is that if we can disclose everything, and we don't have everything known about this trillion-dollar market, which is so frightening, and you're suggesting, and there'd be a central clearinghouse, and we learn more about it.
For credit default swaps.
For credit default swaps, yeah. But to say after that, when we disclose how it's doing, to say even in another instance of another, whatever you want to call it, you might have an agency that says, we're not going to let you do it. That would be a major step forward in the history of this country, wouldn't it?
Well, look.
Or backward. Some people say a major step backward.
If you go back to, let's say, go back to the last major market crash, 1929, the 30s, and so forth, we set up a system of regulation. The Federal Reserve was charged with regulating banks, and the SEC was charged with investor protection. Now, the Federal Reserve regulation of the banks is prudential regulation. What that means is that their job is to go into a bank and to make sure that there's nothing going on in that bank that would threaten the banking system.
Mm-hmm.
Okay.
Okay, so that's the
and if there is, they'll correct it quietly inside. But their mission is to make sure the banking system works. The SEC, on the other hand's mission is investor protection. The SEC is a law enforcement agency. Now it does what it does via disclosure, as you say. That's the methodology. Just complete disclosure of the accounting that's used, et cetera, et cetera. What's happened is with Graham Leach Bliley and everybody else's business, this neat packaging of banks and investment banks and so forth has broken down, and that's opened up great gaps in the regulatory mechanism. So what we're going to have, I believe, is a reorganization of who does what to whom,
yeah.
and responsibilities that cover the new kinds of organizations, and that's only the beginning, because once we do that domestically, we're now in a global marketplace. Stocks, bonds, so forth are traded all over the world. So we have to somehow get an international global mechanism going where so that people who want to do bad things in the marketplace, let's say, can't go to some other jurisdiction and get them done. That's going to be very tough to get done.
Let's come back to that in a second, give you a chance for glory, if I may say so. And by the way, I found that what you just said immensely interesting. For someone who's a Republican, I have to listen very closely. Hedge funds. You deserve glory, it seems to me, because you, against the votes of members of the Republican Party, got the SEC to regulate hedge funds. And when I was looking through some of the clips about your role in this, there's a statement in there, I don't know if you remember it. This seems a lot like 1929 to me, says Bill. And we should have that up on the screen, you know. I just put the tough stuff up on the screen. Did we make a big, well, the courts took it away from you, but Congress, everyone was fighting on you. Was that sort of a, what do I say, a communal, societal mistake not to realize, as you did, that these hedge funds needed regulation?
Well, first of all, the word hedge fund implies that these are funds that make their profits through hedging. This is not so. Hedge fund now are pools of capital. They can invest in anything, and many of them don't hedge at all. So we have these pools of capital which are unregulated, and back when, and growing like a weed, again, because they're unregulated, nobody knows exactly the size, but there's probably close to $2 trillion worth of money inside vehicles that have been unregulated. And you know, what we set about to do was to regulate those vehicles under the Investment Advisors Act, which simply gave the SEC the authority to go into these funds, look upon what was happening inside them, more importantly, examine their impact on the marketplace itself, because every time a hedge fund buys or sells something, it's doing it with individuals, its counterparty, or institutions, or foundations, or whatever. So that it just seemed crazy to have this much money totally outside of any regulatory authority.
I want to talk again about how we're going to deal with hedge funds internationally, but one of the problems I don't think the public generally understands with the present market downturn is these hedge funds are unloading their stocks and other securities, and it's part of the problem of driving the market down. And from a common sense point of view, not to know, what sort of risk they're taking on when they screw us all up, just doesn't seem fair. President Nicolas Sarkozy has been much on the forefront of wanting something like a Bretton Woods, where you make an actual agreement. And he's been on the forefront of wanting to regulate hedge funds through an international agreement. Now, you were just saying that some sort of institutional mechanism is going to be needed to deal with these regulatory issues. And more precisely, how do you think this is going to play out, and what should be done, and so forth?
Well, let me first of all say that I would not condemn all hedge funds. Okay, I mean, this is a huge industry, and there are a number of people that are running these pools of capital in a very responsible way. That's number one. Number two is, we throw around the word regulation, and you throw around, it's funny for you, a Republican, talking about regulation. I happen to believe very strongly that in the marketplace we've got to have traffic lights, if you will. I mean, the free market theory that all you need is you don't need anything at an intersection, just a blinking yellow light, doesn't work. We have to have rules. We have to have rules.
We have to rules, and we've come to the end, can you believe it? And so if you have to have rules, it probably means an international agreement like the Bretton Woods. In fact, I'll ask you this, Bill Donaldson, do we need a Bretton Woods type agreement, yes or no?
Well,
you don't have to say. You don't say something else if you don't want to say yes or no. No, we don't.
Well, no. I mean, basically, Bretton Woods, as you know, was a instrument, a meeting of the nations of the world right just after World War II. That's basically was addressing international rules for currency valuations and so forth. The problem now.
We'll have to be short because we run out of time. So the question again is exactly, are you in favor of either an agreement or a consensual approach that doesn't amount to an agreement, or in between?
I think that first of all we have to get our own United States regulatory agencies moved around so we're covering the
waterfront. Yeah.
And then secondly, we have to work toward some coordination. We have good coordination now in terms of enforcement. We exchange information and cooperate in chasing the bad guys. But when you get to standard regulation throughout the whole world,
yes,
you're dealing with very different countries, different ideas of what's wrong.
Maybe impossible to do.
It's almost impossible. I think, yeah.
Thank you very much for coming by, Bill Donaldson.
Nice to see you.
And thank you very much for coming by, and come by next week to learn more about the digital age. For the digital age, I am James Goodale. Good night.